In September 2008, a bank older than most countries vanished in a weekend. Lehman Brothers, 158 years of history, collapsed like a sandcastle hit by a wave. By Monday morning, over $600 billion had effectively evaporated. Retirement accounts shrank. Businesses froze. Millions of people who had never heard the name Lehman felt its death in their bones. Jobs disappeared, savings dissolved, entire futures were erased. But here's the uncomfortable truth. The real cause of the disaster didn't start on Wall Street in 2008. It started years earlier, with a promise so simple it could fit on a billboard. Why rent when you can own? Cue the upbeat music. It's 2002. America is stumbling out of two punches in quick succession: the dot-com crash and 9/11. Confidence is shaken, markets are nervous, fear lingers in the air like smoke. The Federal Reserve steps in with a solution that seems almost too easy. Slash interest rates. Not a little, not carefully. All the way down. Suddenly, borrowing money feels painless. Credit cards feel lighter, loans feel friendly, mortgages feel inevitable. Money becomes cheap. And when money is cheap, people stop asking hard questions. Buying a home transforms overnight. It's no longer a careful life decision, it's a celebration, a rite of passage, a badge of adulthood. Banks begin approving loans like party favors. Congratulations, you qualify for $500,000. But I make $40,000 a year. No problem. Adjustable rate mortgage, balloon payment, teaser interest, don't worry about the details. And then comes the most dangerous innovation of all. The ninja loan. No income. No job. No assets. No problem. Homeownership stops being about shelter. It becomes an identity. It means success, stability, respect, a lawn with a fence and a grill, and everywhere you look, ads, seminars, TV shows, the message is relentless. Renting is wasting money. Owning is winning. Banks don't just agree, they accelerate. Mortgage brokers start throwing loans at people who can barely spell mortgage. Credit checks soften, down payments disappear, verification becomes optional. If you have a pulse, you qualify. McDonald's workers buy condos, baristas buy townhouses. People with $5 in savings walk out with keys to homes they don't understand. Why worry about repayment? If things go wrong, the house will be worth more next year anyway. That belief becomes gospel. Housing prices climb, then sprint, then explode. Your neighbor's home doubles in value in months. This isn't alarming, it's normal. Everyone feels rich on paper, everyone feels smart. And nobody wants the party to stop. By 2005, something fundamental shifted. Buying a home is no longer about living in it. It's about flipping it. People own 2, 3, 4 properties, they don't visit them, they don't care about neighborhoods, they care about spreadsheets. Real estate becomes a game of musical chairs, and everyone assumes the music will never stop. Teachers become speculators, waiters become landlords, office workers become investors. Zero down, interest-only payments, adjustable rates ticking like time bombs. Behind the scenes, mortgage brokers are minting commissions. Loans are written, sold, and forgotten within days. No one is incentivized to ask, can this person actually pay this back? Because that's not their problem anymore. And that's when Wall Street enters the story. Banks don't want to hold risky mortgages. They want to sell them. So they bundle thousands of home loans together and create something new. Mortgage-backed securities. In theory, it's diversification. In reality, it's camouflage. Bad loans are mixed with decent ones. Risk is buried under complexity. Then the final touch is added, the stamp of approval. AA-rated. Safe, stable, trusted. Who decides that? Ratings agencies. The same agencies are being paid by the banks selling the products. It's like asking a student to grade their own exam and rewarding them for passing. But Wall Street doesn't stop there. They take those mortgage bundles and slice them into even more complex creations. Collateralized debt obligations. CDOs. Financial alchemy. Turning debt into diamonds. At least on paper. Risk doesn't disappear, it multiplies. And still the party grows louder. Not everyone is celebrating. A small group of outsiders reads the fine print, they dig into the loans, they notice patterns that don't feel right. Borrowers with no income, no assets, no buffer, loans that reset to impossible payments. They ask a dangerous question. What happens when housing prices stop rising? The answer is terrifying. But there's a problem. There's no way to bet against the housing market. So they go to Wall Street and make a request that sounds absurd. We want to shorten it. The banks laugh. Then they think. Then they realize there's money to be made. So they invent a product that will eventually light the fuse. Credit default swaps. Insurance against failure. You pay a premium, if the mortgage bonds collapse you get paid. The catch. You don't have to own the bonds to buy the insurance. You can insure something you don't own. Bet on a failure you didn't cause. The system becomes a casino built on leverage. And everyone is convinced the house can't lose. At first the warning signs were quiet. A few missed payments. A few empty condos. A foreclosure here and there. But then something impossible happens. Home prices fall. The foundation cracks. Adjustable rates reset, monthly payments jump, borrowers drown. Subprime loans implode. Then the securities built on them follow. Banks look at their balance sheets and realize the truth. Their safe assets are radioactive. No one wants to buy them. No one can price them. Trust evaporates. Losses explode across hedge funds and investment banks. And then September 2008. Lehman Brothers collapses. No bailout, no rescue. Just silence. The message is immediate and brutal. If Lehman can fail, anyone can. Banks stop lending. Not cautiously, completely. Credit, the lifeblood of the economy, freezes solid. Companies can't make payroll. Families can't get loans. Businesses can't survive. Retirement accounts shrink by the day. Jobs vanish by the millions. This isn't just Wall Street burning. It's Main Street suffocating. And the fire spreads. Europe buckles. Asia trembles. Global markets crash in unison. Iceland's banks collapse. Stock exchanges plunge worldwide. The Great Recession has arrived. The US government faces an impossible choice. Let the system collapse or save the very institutions that caused it. They choose survival. October 2008. $700 billion. The Troubled Asset Relief Program. Banks are injected with taxpayer money, insurance giants like AIG receive lifelines, auto companies are rescued. At the Federal Reserve, the rulebook is thrown out. Interest rates drop to zero. Money is created digitally. Bonds and mortgage assets are bought en masse. Quantitative easing. Unthinkable before, necessary now. Markets stabilize, banks breathe again. But for ordinary people, the pain lingers. Unemployment hits 10%. 8 million jobs vanish. 4 million homes are foreclosed. $19 trillion in household wealth disappears. Families who did everything right lose everything anyway. Meanwhile, Wall Street bonuses return. The contrast ignites rage. In 2011, tents filled a park in New York City. We are the 99%. The message is clear. Profits are private. Losses are social. No major executives go to prison. No real accountability arrives. The system survives. Trust does not. The crisis didn't come from one villain. It came from a belief that housing always goes up. That risk can be engineered away. That complexity can hide reality forever. Every crisis starts the same way. It looks safe. It feels profitable. It feels inevitable. Until it is. Because the most dangerous lies aren't the loud ones. They're the ones that sound like common sense. Why rent when you can own?